Hey, this is Annie Dickerson with Goodegg Investments. Ready to talk real estate? Let's get cracking. I just wanted to share one quick story with you about the power of the tax benefits when investing in real estate. Namely, I wanted to talk to you about depreciation and cost segregation. Depreciation allows you to write off the value of the real estate asset over time. And cost segregation is a way to accelerate that. So if you're investing in a real estate syndication that's only going to hold a property for 5 years, you don't want to write off the value of that property over 27 and a half years. That means you're leaving 22 and a half years of write-offs on the table. That's what cost segregation allows you to do. And so let me tell you a quick story. I know someone who invested in a real estate syndication in December of 2016. The following spring, the spring of 2017, they received their K-1 for their taxes. And what that K-1 showed was that for that single month that group held that asset in 2016, that single month of December 2016, for an investment of $100,000, there was a paper loss of $50,000. And what that means is that $50,000 paper loss allows you to apply that $50,000 write-off to your other income. So together, depreciation and cost segregation can be hugely beneficial for any real estate investment. Well, that's it for now. Until next time, have a sunny side up day.